All right, as I promised you at the beginning of this episode, I want to talk a little bit about inflation. Inflation, it's been in the news a lot the last few years, but honestly, it's something that investors ought to be thinking about all the time. Neurologist and financial guru Bill Bernstein talks about the four deep risks when it comes to your finances. And these are inflation, deflation, confiscation, and devastation. Deflation's like the Great Depression, right? Confiscation is like when Russia came in, became communist, and took everything. Devastation is like World War II, when every city in Germany had the snot bombed out of it, right? But of all these deep risks, the most common one to show up in world financial history is inflation. It's pretty common, happens all the time, both just kind of regular high inflation like we've had the last year or two, as well as Zimbabwean style hyperinflation. And so inflation is something you want to be thinking about a lot when it comes to portfolio design and when it comes to everything. In fact, you should get used to thinking in terms of real. And when I say real, what that means is after inflation, numbers and figures. Okay. So when you're thinking, I need this much money, to retire on in a few years, you need to be thinking about that in terms of, today's dollars. I need $3 million in 2023 dollars is what I need. Now, by the time you get to that point, that's going to be more than $3 million. Maybe it's 3.6, maybe it's 4.2, whatever, right? But the point is, you got to get used to thinking in terms of after inflation numbers. Same thing when you're thinking about your investment returns. It's wonderful. You made 9% this year. But if inflation was 4%, you really only made 5. Now, I wish the IRS would think this way. They do not. They make you pay taxes on that inflation. And that's an unfortunate thing about our tax system, such as it is. But you need to learn to think in terms of inflation adjusted numbers with everything, whether that's returns, assets, etc. My favorite place to go for inflation data is a website called inflationdata.com. And the nice thing about it is, as soon as the federal government comes out with its inflation figures, they're published here, and you can look back historically at what inflation has been. And you can also look at the current inflation data. The one you see in the news most of the time is the year over year inflation figure. And, the current inflation rate is what they often call it. And as I record this on June 16th, 2023, that rate is 4.05%. So over the last 12 months, in general, as measured by the government, using their consumer price index for urban consumers, prices have gone up 4.05% over the last 12 months. And that's a lot better than it's been for the last couple of years. I mean, inflation peaked, from all the liquidity and low interest rates that have been going on with our economy to try to save it from the COVID pandemic. They probably overshot the mark, obviously, in retrospect. That peaked at over 9%. And you can see that when you look at this, current inflation table that they have there. If you go back, you can see, in June of 2022, it hit 9.06%. That's over the prior 12 months. If you go back to 2020, you can see at one point, that rate was almost 0%. In May of 2020, the prior year's inflation was basically flat. There was no inflation. And then from that point on, it climbed and climbed and climbed. By the end of 2020, it was 1.36%. By the end of 2021, it was 7.04%. And then it peaked in June of 2022 at 9.06%. By the end of 2022, it was down to 6.45%. And with the most recent data, it's 4.05%. Historically, inflation has been about 3% over the decades. Obviously, sometimes it's higher, like it has been the last couple of years, and sometimes it's lower than that 3%. You should be aware that the Fed's part of their mandate is to keep inflation under control. And they are actually aiming for about 2% inflation. That's where they've decided, the economy seems to grow best at about 2%. That number is actually kind of just pulled out of random air. It's really all about the expectation. That probably could have been set at 1% or 2.5% or whatever. But the point is to have people expect something and then deliver that. That's what seems to allow the economy to grow. The economy doesn't like uncertainty. And so that's what you ought to expect. That's what the Fed's trying to do. They have pretty good tools to keep this under control in the long run. And you ought to expect them to use them. And that's why when inflation got out of control, boy, you started seeing them hiking interest rates like crazy. I think for 3 months in a row, it went up 3/4 of a point, their short-term interest rates, and they started reining in all the liquidity they'd been pumping into the system. More interesting chart on this inflationdata.com site, and they've got some cool calculators there too. But my favorite chart is under a tab, they call it the monthly inflation data. And rather than summing everything over the prior year, this actually tells you what it was over the prior month. And if you look back, you can see that, of course, inflation is going to be lower now than it was a year ago, because there's actually been negative inflation for 4 of the last 12 months. Last July and August and November and December, it was actually negative. We had deflation, not just disinflation, which is a lower rate of inflation, but deflation for 4 of the last 12 months. And then you can also see, it's also interesting to see the pattern that inflation is generally higher in the first few months of the year. January, February, March is when people tend to raise prices and get raises at work. And so inflation's often higher in the first few months of the year than it is later in the year. But it's very interesting to look at that month-to-month data as well. And, that was very reassuring last year, even though the one being published was really high, to look and see that going month to month, inflation has already been coming down quite a bit. So that's good. Inflation is bad for investors. It is not a good thing. It makes your money that you have worth less. And so getting this back down to a low rate is important to keep the economy growing and to keep your nest egg growing. But my point is, start learning to think in after inflation terms.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.